Welcome to today's Explainer. We're going to be breaking down how some truly massive macroeconomic forces are dictating global currency flows right now. If you've been watching the markets this Wednesday, July 22nd, you already know there's a serious amount of turbulence out there. So we're going to unpack exactly what is driving the whole shebang. Let's kick things off with a massive question that really frames our entire discussion today. Why on earth has the Japanese yen plunged to depths we haven't seen in nearly 4 decades? 1986. To understand how we got to this low, we really need to pull back and look at the broader global map. Okay, here's the roadmap for today's tour. We'll start with the global macro battlefield, dive into the Japanese yen crisis, look at the Swiss franc as a funding currency, check in on the European Central Bank watch, and wrap things up with the Hungarian forint holding the line. Alright, Section 1, the global macro battlefield. AI and energy propel the dollar. So there's a really stark contrast right now between the winners and the losers in today's market. On one side, you've got this high-yield haven, the US dollar. It's being powerfully supported by a super resilient risk appetite that's anchored directly to the ongoing AI tech boom. Honestly, the AI boom is essentially serving as the high ground for the dollar. But then on the flip side, we have our low-yield defenders, specifically the Japanese yen and the Swiss franc. These guys are just being absolutely punished by surging global energy prices. It's a classic collision, right? You've got this risk on AI enthusiasm slamming right into the inflationary pressure of energy costs, and that clash is dictating exactly where global capital is flowing. Moving on to Section 2, the Japanese yen crisis, a policy referendum. 163. The yen recently plunged right past that 163 threshold against the US dollar. Like we talked about a minute ago, this literally hasn't happened since 1986. But here's what you really need to take away from this number. 163 is no longer just some technical milestone. No, it's a live referendum on Japan's entire macroeconomic policy mix. The global market is actively testing their strategy right now. So the absolute crucial point here is understanding Japan's double-edged sword, and it basically unfolds in 3 key steps. Step 1, you've got wide interest rate differentials and incredibly cheap borrowing costs in Japan, and that's fueling a relentless carry trade. Investors are just borrowing cheap yen to go out and buy higher-yielding overseas assets. Step 2, as geopolitical tensions push crude oil prices higher, Japan, which remember relies heavily on imported energy, sees its import bill climb dramatically. And that leads us straight to Step 3. The currency structurally weakens under the crushing weight of both those capital outflows and the higher energy import costs. It's a tough spot to be in. And honestly, this just brilliantly illustrates the Bank of Japan's cornered position. While Japanese authorities absolutely have the capital to execute massive foreign exchange interventions, well, these actions have proven to be merely fire extinguishers. Think about it. If they tighten policy too aggressively, they threaten domestic growth and paying their public debt. But if they move too slowly, the yen collapses. So what do? They intervene. But these fire extinguisher interventions, they only create violent, short-term tactical reversals. They fail entirely to change the underlying trend. So how do they actually fix it? Well, a durable recovery for the yen requires real structural shifts, not just more fire extinguishers. The market desperately needs to see one of 3 things happen: a material drop in US Treasury yields, aggressive tightening by the Bank of Japan, or sustained capital repatriation by major Japanese institutions. Without those fundamental changes in flow, the market's just going to treat these intervention-driven dips as buying opportunities. We could easily see this thing grinding toward 164 or even 165, ahead of the BOJ's July 31st policy meeting. Okay, on to Section 3, Swiss franc, a funding currency casualty. Now, the difference in reactions between these 2 low-yield defenders is wild. On one side, we just talked about the Bank of Japan, right? They're cornered, deploying reserves to fight the weakness. But then, on the other side, you have the Swiss National Bank. The SNB seems entirely comfortable with the weaker currency. They were actually one of the last major central banks to hike rates, and they are highly unlikely to deploy massive FX reserves to prop their currency up. They are perfectly fine just letting it weaken without putting up a fight. But this hands-off approach definitely has consequences. Because the SNB isn't fighting back, the widening interest rate differentials against the US dollar are making the franc an increasingly attractive funding currency for investors. It's practically an invitation. And if energy prices keep climbing, this dynamic could see some really powerful follow-through. We could potentially see the USD-CHF pair break through key resistance levels right in that 0.8150 to 0.8170 range. Alright, Section 4, European Central Bank Watch, Inflation and rates. €60. That single number is what's really driving European Central Bank fears right now. Natural gas prices are retesting €60 per megawatt hour. To put that into perspective, this creates a massive inflationary threat across the entire continent, which directly challenges the central bank's core mandate to keep prices stable. It's a huge headache for them. So as a result of this looming energy threat, the euro to US dollar pair is desperately clinging to support above 1.1400. This resilience, it's largely because the markets are already pricing in an aggressive tightening response from the ECB to combat that natural gas inflation. But here's the catch. The realistic ceiling for those ECB weights might actually already be priced in by the market. Because everyone expects this aggressive tightening, there's actually a downside bias toward 1.1380, as the market just kind of waits for the upcoming ECB policy meeting and press conference. Meanwhile, just across the channel in the UK, Bank of England's hawks are finally breathing a sigh of relief. Despite a slight upside surprise in June's broader data, we're seeing a sharp deceleration in core pro services inflation, which is a vital metric for the Bank of England. As you can see, it has dropped cleanly from 3.8% down to 3.6%. Now, why does this matter? Well, because when you pair that drop in services inflation with softening private sector wage growth and, get this, a rare second consecutive monthly drop in food prices, you get a significant cooling of domestically generated inflation. This kind of structural improvement in the UK is absolutely vital because it could solidify a floor for the euro to sterling pair near the recent lows of 0.8455. Finally, Section 5, Emerging Markets. The Hungarian forint holds the line. The big number you need to know here is 5.75%. The National Bank of Hungary just delivered a widely expected 25 basis point rate cut, which brings their base rate exactly to this figure. But more importantly, they did this while maintaining very transparent, dovish forward guidance. Basically, they're keeping the door wide open for continued gradual easing. What is really fascinating here is just how incredibly effective that transparency is proving to be. Look, emerging market currencies are broadly being pressured right now by the strong US dollar and just generally volatile global risk sentiment. But the National Bank of Hungary's transparent policy path, mixed with a backdrop of downside inflation surprises, is providing real stability for Hungarian assets. Because of the stability and the central bank's promise to reassess things in September, the EUR/HUF pair is actually really well positioned to retrace below the 360 level. That is, if the broader macro environment decides to calm down a bit. And that big if brings us right to the end. It leaves us with this final, provocative thought to take away from today's Explimal. Will the broader global macro environment actually stabilize enough to save these battered defensive currencies? I mean, as long as the resilient risk appetite for AI and the inflationary surge of energy keep dictating the weather, can any of these low yielders truly find shelter? It is, for sure, the ultimate question driving the flows we've unpacked today. Thanks so much for diving into all this data with me, and definitely keep your eyes on those charts.